You're watching Beyond Markets. Welcome, I'm Esther, Awoniyi. Many thanks for joining us. On today's show, we'll discuss the IMF's Article 4 consultation with Nigeria. You can join the conversation with the hashtag Beyond Markets, and of course, you can follow my Twitter handle too. It's at Esther O. Awoniyi. Now, the International Monetary Fund has concluded the Article 4 consultation with Nigeria, and the Executive Board says Nigeria's medium-term outlook remains muted, with risks tilted to the downside. The IMF projects growth of 2.1% for 2019 and 2.5% for 2020. Amine, IMF's mission chief and senior resident representative for Nigeria, joins me for today's discussion. Amine, thank you so much. It's a pleasure to have you.
Thank you very much for having me.
So here we are again, another Article 4, on Nigeria, just in IMF, just going over the state of the economy from the last time. I think this was sometime around March last year. Correct. So basically, this is a year later now, 1 year later. So let's talk about the key outcomes or key takeaways from your consultations or your views on Article 4 this time. On the fiscal front, you say that there's still fiscal challenges, the structural imbalances still remain. You mentioned things like the large infrastructure gap, low revenue mobilization, and of course the FX issue. But just briefly, just summarize what your key views are and what you saw when you came.
Okay, so let me step back since we're looking at what happened over the past year.
Okay.
And when we had the board meeting, when we did our evaluation, one thing that came clear is that Nigeria is recovering from the terms of trade shock and collapse in the oil price that has happened in 2014-15. We had growth at 1.9% in 2018, up from 0.9%. Inflation has been significantly reduced, and external buffers have recovered from the low level of 24 billion that they were in October 2016. Challenges remain. Unemployment is high, poverty is high, large infrastructure gap is there on the power sector, road infrastructure, and revenue mobilization is still one of the lowest in the world, at non-oil at 3.4% of GDP. And on our recommendations, our advice on an urgent implementation of a coherent package of measures is still there. Those are increasing revenue mobilization from the 3.4% of GDP of today, unify the exchange rate, keep monetary policy tight, and advance on structural reform priorities, including the power sector, governance, financial inclusion. One good news about all of these priorities is that they are all, or most of them, are aligned with the authority's economic recovery and growth plan. So the implementation of that plan remains urgent and important to try to get the economy out of this 2.5% growth rate that we are projecting currently.
Okay, so you're saying that this, obviously you're comfortable with the ERGP, but you also say in this particular consultation that you would like to see a speedy implementation and that there is actually no need for this new, the government is continuing to wait for the appointment of a new cabinet. So, the ERGP, it's got mixed views. I've spoken to the last 4 years, spoken to economists and analysts on the ERGP, and at the end of the 4 years, what the general consensus has been is that it hasn't given us the economic momentum that this economy needs to bring it out, or at least to put it ahead of population growth, as it were. But with what you've seen on the ground, and you saying that this is an opportunity for this government to continue and perhaps accelerate things, in what ways can this government begin to accelerate some of those reforms? And what are those key within the ERGP that you think are most urgent for this government to focus on?
Absolutely. And let me go and step back again. The ERGP is part of this government's agenda, and I believe the transition committee being headed by the vice president is looking at some of the evaluating what has happened and some of the priority measures under the ERGP that could serve the next administration. On our side, in terms of our recommendations, on the quick impact, I would say revenue. Start with how to increase. The ERGP has a target of trying to go from 5 to 15% of GDP. To get there, you need to have a package of measures on both tax policy and tax administration. Tax policy, VAT reform is one, and VAT rate is low, 5%, but the VAT compliance is also low at 25%. Excise, it's 0.1% of GDP, one of the lowest in the world. If you look at emerging market average, it's about 3.5% of GDP. The excise rates in Nigeria are 4 times lower than the ECOWAS average. So those are some of the measures that can be put in place. Also, let's look at VAT exemptions or tax exemptions, which are narrowing the tax base.
Sorry to butt in. You have said, IMF says that there should be an aggressive removal of those tax incentives and removals.
Yes, we think that this will help widen the base. You can look at the corporate tax rate in Nigeria is 35%. When we look at the effective tax rate coming from the profit tax coming from corporations, we find that it's less than 10%, which means that there's a lot of leakages that went, including because of the exemptions. And this is one way of widening. You know, one could look at it that if the exemptions are removed, then there may be a way to simplify removing the exemption and also lower a bit the corporate tax rate, which is at 35%, and try to widen the base that way, in addition to moving quickly on indirect taxes, VAT, and excises, which can help boost revenue. And you know, the revenue target appears ambitious, but it has been done by some other countries. In the report, we quote Georgia and Liberia, who did it in a very short period of time. And one of the key reasons for success for such a rapid and big mobilization is high-level political commitment to move ahead on those reforms. So this is, you know, one of the key reform that we think is necessary, and not just to increase revenue, reduce borrowing and the deficit, but because this is necessary to create the space for higher spending on infrastructure. We've talked about in our report that health and education are some of the lowest spending numbers with respect to GDP in the world, and there's a lot of spending that needs to be made. And in Nigeria, this is not the case that spending is too high. It's actually too low and need to be going up, but you need the resources for that.
I mean, speaking about spending, if there's one thing that's a big burden for this government now, that could be a problem. Obviously, one of the reasons for the urgent need for revenue mobilization is what is being spent on debt servicing. That's still about over 60% right now of what the government makes. And the government has said through the Ministry of Finance that, look, it's going to look more to international borrowing, Eurobond, which is something that the IMF that you're happy about, that you say they can look to, and also concessionary loans. But right now, looking at the domestic market, there's still that crowding out effect. So do you see this, I mean, any ease in coming soon? I mean, the government applying this and just waiting to see if we're going to see that desired effect? I'm talking about, you know, being able to meet the deficit on the one hand and also reduce the debt burden.
I think meeting the deficit is going to require revenue mobilization. And when we talk about debt, in Nigeria, let's not forget, debt to GDP is still relatively low. It's 25–30% of GDP, even if we were to include AMCON debt. So it's quite low. The interest payment to revenue is high, 60% is the number that you have quoted. But I see that less as an issue of debt, but as an issue of low revenue being very low. Hence, the emphasis on increasing revenue. As to the government strategy of 60–40, 60 external, 40 domestic, we think it's appropriate, and we looked at it with different costs. And even if from today the government were to borrow externally to try to reach that target, we still find that interest payment to revenue and debt to GDP, and we have that in our papers, is going to be lower under foreign financing than under domestic financing. The one caveat is that the external debt service over reserves would be higher under an extreme exchange rate shock. So that's why we call in our report to monitor the exchange rate risk. Okay,
so let's move over to monetary policy. Now, as you know, we recently had a monetary policy committee meeting where the MPR, the headline rate was slashed by just 50 basis points to 13.5%. Now, you recommend in this article that, you know, the monetary authority should continue tightening. Now, that has been a source of controversy in here for as long as I can remember, because what has happened is that it's come at the expense of growth. But now the CBN has said that it's realized, what the impact is, the negative impact it's had on the growth, and that, it's hoping that this can, we could see an impact. I'm not sure to what extent we're going to see that, but that has been the case. But you are very much in favor of that tightening. Explain to us, I mean, how this works, because you must realize also that it's also been a case where we've had to sacrifice growth.
We realize that, and we understand that there's a trade-off between growth and inflation. But low inflation increases the purchasing power, also decreases the yields, creates more space in the banking system for the private sector. As the lending rate goes down, then you get more demand on the consumer side. So there are positives that are happening on that side with inflation getting lower. How do you get inflation lower? Is through tight monetary policy. I think in Nigeria, tight monetary policy over the past year and a half has contributed to inflation being significantly down. But when I talk about tight monetary policy, I also want to clarify that de facto monetary policy in Nigeria is being measured by the OMO yield, the money market rate, which is higher than the 14% policy rate, or today the 13.5% policy rate. So when we talk about tightening the monetary policy rate, is to go back to having the monetary policy rate reflect the actual tightening conditions in the market. So if the money market rate should be aligned with the policy rate, and today the money market rate, or the OMO yield, which kind of measures the policy stance, is higher than that. And that's one factor that we are talking about. We're also talking in our report replacing heterodox monetary policies with more traditional methods, which is using the policy rate and also having the cash reserve requirement that is more symmetric. Currently, there's an asymmetry in the cash reserve requirement where the regulation is 22.5%. Means that when you have a deposit coming into the bank, 22.5% is kept as required reserves. But when deposits leave the bank, that deposit is not given back. So the required reserves is still kept at the bank, which means that effectively you do have a cash reserve requirement that is above the 22.5 for banks, and depending on the banks. And this is one of the reasons why we talk about using traditional methods on monetary policy. But I want to clarify again that when we talk about tight monetary policy, it's really to reflect the actual market conditions.
Okay. I mean, I must thank you for your time so far. We'll take a quick break, but we'll come back and just wrap up some other points I wanted to speak on monetary policy when we come back. I've been speaking to Amine Mati. He's the IMF's Mission Chief and Senior Resident Representative for Nigeria. We'll continue our discussion right after the break. To join us again. Welcome back to Beyond Markets. If you're just joining us, Amine Mati, IMF's Mission Chief and Senior Resident Representative for Nigeria, is with me today, and we are discussing the IMF's Article 4 consultation with Nigeria. Amine, thank you so much for your time so far. Let's quickly wrap up on the monetary policy side. Now, some of the comments or views on the monetary policy that I read in the document also talked about the CBN's, what the CBN has been doing in terms of the interventions in some sectors, particularly power and agriculture. You've said that you'd like to see the CBN discontinue that and, of course, focus on its mandate of, exchange rate and price and exchange rate stability. But, I think the CBN does realize that it's the fiscal authorities who should be doing that. But I mean, when we have a situation where that's not coming, that's not coming through, and we're seeing that negative impact on the economy, then it step forward. But that also has been a source of controversy. But just speak to us on this and the negative impact you think it may be having in terms of perhaps maybe distracting the CBN from its core mandate.
I think the main reason that we look at that is this is an intervention that's mainly should be done by the fiscal authorities. If this is an intervention that needs to be done, it should be costed, discussed in the budget appropriation process, and then done in terms of the spending. And our main concern is the conflicting objective it could send about the CBN's mandate and on price stability. So on one side, the central bank was tightening. On the other side, it was intervening in different sectors. It was providing liquidity that it had to mop up itself at a high cost. So we thought if this is a priority for the government, then the government should do it, or the development agency or development bank, and the central bank should stay in its core areas of trying, and which and go back to what it says is its primary mandate, which is price stability.
Let's quickly talk about the exchange rate. Now, we've seen a bit of a convergence in the last 1 year, but of course, for most analysts, market participants that I've spoken to have said, one single exchange rate, will be desirable. But it would appear that right on the CBN says that, while that is desirable on its own part too, we may not be ready for it. But you have, obviously, IMF has a different view, and you've said that the greater exchange rate flexibility should be allowed to respond to shocks. Talk to us about, your thoughts on the exchange rate flexibility, where we're going with this, still having multiple exchange rate market segments. But just how you see this, perhaps the end game, if we do not begin to, close that gap right now.
I think if you look at our report, the authorities and the central bank has also said that its objective at the end will be to unify the exchange rate. I think there's a difference in terms of the sequencing. We think it should be done now. We think it will help remove distortion, and it will help attract a lot of the long-term investment. So far, what has come in Nigeria is a lot of carry trade and portfolio investment. And our recommendations on the exchange rate is to respond to shock and let the exchange rate move only in case of large shocks for large fluctuations, which the IND window can do. But then you have the 305 rate for the fuel importers, which is a rate that is still considered the official rate by some, and then you have the retail rate. And I also want to point out the convergence has happened. It just has not happened as quickly as we would have expected, particularly as some of the markets are, most of them still operating at the IND rate. Therefore, the convergence now could probably happen a lot quicker.
Okay, well, that is good news. Let's quickly move over now to the banking sector. You focused on, especially the tier 2 banks that you say still undercapitalized and could weigh on the banking sector. You also were recommending to the CBN to enforce that no dividend distribution rule to all banks, especially those that have restructured loans that are still concentrated in the oil and gas sector. Could you elaborate further?
On the banking sector, prudential ratios have indefinitely improved. Capital adequacy ratios at 15%, used to be 11. NPLs used to be at 15, they're at 11. So the improvement is there, but you have 4 undercapitalized banks that continue to weigh on the sector. The good news about those banks is that they're only 5% of banking system assets. And if you were to remove those banks, the performance of the sector will be much higher, and there'll be more confidence into the soundness of the system. Now, because of the importance of the restructured loans in some of those banks, we have, and it could go from 3 to 30%, we have recommended that an asset quality review be done on some of the banks to assess the quality of this loan portfolio and to ensure that there is no hidden skeletons later on that could hit the capital of the banks. And coming back to that, that's one of the reasons, and in view of those risks and potential, if there's another shock that comes in, one of the reasons why we are saying it's important to build capital buffers, including by withholding dividends.
I thought that the implementation of the IFRS 9 would sort of to some extent take care of that, or at least bring that to the fore.
Implementation of IFRS 9 will bring some of that, but let's not forget that we also have a transition arrangement for 4 years that has been put in place for the IFRS 9. So it's going to take time for all the provisions and the prudential regulations for IFRS 9 to be fully implemented by all the banks.
And I also know that from time to time the CBN does conduct a stress test for this bank, and that's how we know the level of NPLs in the industry and what the central bank has had to do in terms of perhaps are you advising increased supervision?
I think the increased supervision, and I think the central bank is doing that with its monitoring, and also when conducting stress tests to have more scenario stress testing as opposed to individual shocks.
Okay, let's get back to the Nigerian economy now. We're still growth is still around averaging 2%. We're going to see, according to your article, 3%. We're not going to hit 5% anytime soon. And you have said that under the ERGP, the 7% target of the federal government may have been too ambitious. But key to achieving all of this will be capital spend, driving infrastructure. And what we have always known is that the government needs to create a more business friendly environment and unlock those investments within the private sector, having a private sector-led economic growth. It would appear that there's some linkages that are missing at this point to connect those dots so that we have an economy that is market-driven and also led by the private sector.
Private sector as the engine of growth is a key plank of the ERGP, and we believe is absolutely necessary. For that, you need to have the right business environment, the right business climate in terms of streamlining the regulation, the tax procedure. You need to have public infrastructure present, but you also need to have a power sector that is delivering. That's one of the #1 constraint to doing business in Nigeria. And action on the governance front. I mean, implementation of the government's anti-corruption strategy, including on the governance in the national oil company would be very much welcome.
Now we have this is an economy that's growing, or that has a population growth of about 3%, and we're having annual growth still lagging at 2%. Like you said, and as statistics show, infrastructure or spending on key items like education and health is still also lagging. We have this, surging youth population. So it would appear that, from the macro indicators, point of view, and some social indicators too, we're seriously lagging. And from now till up until 2020, we're still looking at growth at 4%. Maybe that would be just a little ahead of population growth. But I mean, what does that mean for the economy? Do you think that if those policies that you're recommending, or perhaps that you're recommending also, if we do not see an acceleration, the economy could be in some serious trouble?
Well, I think if you look at our baseline, just using current policies, and if our package of policy measures on fiscal, monetary, exchange rate, and structural reforms are not implemented, you will have growth that will stay at between 2.7% over the period, which means either negative per capita growth today or stagnating growth, which puts pressure on services, which is putting pressure on unemployment that will keep increasing. Poverty levels were at 50% using 2010 numbers. Some of the health and education outcomes are also weak, and I think it's going to be very difficult to address those challenges without growth picking up significantly, and hence the importance of implementing this whole package of measures.
But would you also say that, realistically speaking, some of these measures, especially the structural ones on the fiscal side, would actually take a long time?
Let's take the example of the fiscal side, for example, on the revenue. You have countries like Georgia and Liberia that were able to, Georgia, for example, was able to double its revenue from 12 to 24% of GDP in a 4-year period. Liberia was increasing about 7% of GDP over a 3-year period. So these ambitious revenue measures can be done. And let's not forget that not all revenue measures, some of them require legislation, but changes in excises or changes in tax compliance do not require legislation. Power sector recovery plan was also approved by cabinet, and a lot of the steps there can be implemented relatively quickly. So on governance, a number of steps are also taken, including additional resources for the FCC. You have an NFIU unit that has been created, and so steps can be taken on all those fronts relatively quickly. Passage of the PIGB, I know it has been waiting a long time, but this has at the final stage, and therefore all of those reforms could be passed and would be actually a good signal for the investors coming in for on the long term. I
mean, we have 2 minutes left, and before I let you go, I need to hear your perspective on the Africa Continental Free Trade Area. We just heard that Gambia just ratified and it's met the minimum threshold 22, and will now go forward to be implemented. Nigeria is not. I mean, for now, we're not a part of it. But what are your thoughts in terms of how this is meant to, or expected to, transform the African continent in terms of, from a trade perspective, removal of tariffs and just creating the biggest market that we've seen so far?
I think AFCFTA is good for trade, it's good for growth, and it will benefit African countries in general. It will be made more effective if the non-tariff barriers that are already existing in the region are also removed, because they are still existing in some of the regional trade agreements. Nigeria is still consulting internally, and after it finished its consultations, it said that it will decide what to do, and we are waiting to see what comes out of that.
Okay, I mean, we'll leave it there. Thank you so much for talking today. We appreciate
you.
your time on the show. I've been speaking to Amine Mati. He's a IMF Mission Chief and Senior Resident Representative for Nigeria. That's it on Beyond Markets. Thank you so much for being a part of it. Remember, you can watch the show at 5 p.m. West African time daily and have access to all previous episodes of the show on our website. That's cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets. And of course, you can follow my Twitter handle too at Esther Awoniyi. From myself and the team, it's bye for now.